Kia ora, morena everybody, and welcome to the launch of RIAA's latest research report, Engage, Advocate, Collaborate, Unpacking Stewardship in Australasia in 2022. Tēnā koutou katoa, no whakatua hou te moanga remarkables, ko Sharova te awa, ko Hegati te whānau, ko Dina hou, kanui te mehe, kia kātou, tēnā koutou katoa. I'd like to start today by acknowledging the traditional custodians of the land that I'm on today, the Ngāti Whatua Ōrākei tribe. We have a very geographically spread panel this morning, and I know people are tuning in from different parts of Australia, Aotearoa, New Zealand, as well as further afield. I'd like to acknowledge the custodians of the land in which you're on, noting that in many instances, sovereignty of that land was never ceded, and pay my respects to elders past, present, and emerging. So I think it's really important to start this event with exactly why it is we're here today, because as an industry, I think we've all seen and we're all witnessing almost every day this incredibly rapid growth in responsible investment, which has been happening globally and within our local markets as well. So by the end of 2021, leading practice RI reached record highs of 43% of the Australian market and an even greater share of the New Zealand market at 49%. And while that top line growth is a really fantastic story and it's critically important, it's also essential for us to understand what are the drivers of that growth. Because really what we're seeing is that the tools that organizations and RI professionals are using to now solve challenges that are becoming increasingly complex and that are significant in scale are really evolving. And as with everything that happens in RI, they're evolving at an incredible pace. So in 2021, we saw corporate engagement and shareholder action become the second most common RI approach used in Australia. So in 1 year, the assets under management in Australia using this approach grew by 54%. And while in New Zealand, that growth was a more modest 9% in 2021, we've seen a huge amount of work going on in that market as well, with the launch of the Aotearoa New Zealand Stewardship Code in September, which is a piece of work that was driven entirely by the industry to strengthen stewardship practice into the future. And while that's all well and good, a really important question for us to ask is actually, what is stewardship? What does it actually look like for investors? How is it actually being used? And actually, what is it that we are achieving? Because in a market that is growing increasingly skeptical about ESG claims, where greenwashing is an ever-growing threat and legislation is coming at us from different angles, we need to be able to clearly articulate the answers to those kinds of questions. And so today, alongside our research partner KPMG, we launch a first-of-its-kind report into the stewardship practices being used by investors in Australia and Aotearoa, New Zealand. To help us deliver this, I'd now like to introduce Scott Mesley, a partner in KPMG's ESG growth leader. Scott works to accelerate and enable KPMG's ESG response to clients, working alongside a senior cross-functional leadership team, ESG industry leaders, and a global network. He has responsibility for KPMG's ESG growth strategy, solution development, go-to-market, capability development, and investment. Scott has extensive advisory experience, having worked in debt capital markets, restructuring real estate infrastructure, and project finance for corporate, not-for-profit, and government sector clients. Kia ora, Scott. That's quite the introduction.
Thanks very much, Dean. And it's a great pleasure to be here today representing KPMG and moderating our panel session. KPMG's got a very long-standing and trusted relationship with RIAA, and we're pleased to be the research partner for this important report. As part of our impact plan, KPMG is committed to delivering positive outcomes for our planet and for our communities. And the work that we do with RIAA is one way in which we can help to advocate and support the changes that we all need to strive for within our financial services sector. Dean mentioned, the important role of stewardship of RIAA in the capital markets. In many ways, that's the heritage of KPMG and our profession, and we see it's important that we play our role in continuing to act as a trusted steward and custodian of the capital markets, to support the ongoing flows of capital towards positive outcomes. And the work that we ultimately do and the impact we have is through our clients. So we're keen to support you all in working towards more sustainable business practices, minimising impact, negative impact and positive outcomes for all of your stakeholders. The financial services sector has a critical role to play in being a catalyst for the change in the real economy, leading to greater value creation and greater portfolio performance. And KPMG has a dedicated team of sustainability consultants that supports with exactly this challenge. Professionals that work with investment managers, private equity, superannuation funds and banking clients. The team's developed an extensive network of insights into the responsible investment landscape, both locally and globally, many of which have been contributed as part of this research. The team's worked extensively across a broad array of projects, spanning ESG strategy, performance and reporting, climate risk, international sustainable finance regulations, and low carbon advice for investment managers. So we look forward to continuing our support for RIAA and our clients with the advancement of sustainable finance. In this regard, I encourage all of you to get involved in the various working groups that RIAA convenes. We participate in many of these and find them incredibly valuable as a way to collaborate with participants in the sector around the issues and opportunities that are emerging from the broader ESG agenda. Some housekeeping before we get underway today, and I introduce our speakers. We will have an opportunity for Q&A at the end, so if you have a question and you would like to put that in the chat, then please do. But please be aware that the chat panel is open to everyone to access. And today's session will be recorded. So with that, I'll now move on to introduce our panelists today. But first of all, we've got Zsuzsa Balhami Zakar from RIAA, who has been the leader of the research piece. So Zsuzsa looks after RIAA's many research projects, which includes the continued success of existing projects and reimagining RIAA's research for the future. She has an extensive track record as a researcher, spending the last 9 years in academia, has a PhD in sustainable finance, and has worked extensively with investors and the not-for-profit sector in the region on topics such as climate adaptation finance, blue finance, and the identification of environmental risks and opportunities. And Zsuzsa has led the RIAA research team, and so we're going to hand over to RIAA to take us through a summary of the key findings. Over to you, Zsuzsa.
Thank you, Scott, and good morning, everyone. I'd like to, first of all, say a big thank you to KPMG, our research partners, and there are a lot of people who worked really hard on this report. I'd just like to say a huge congratulations and thank you to the young KPMG consultants who contributed. Also, a huge thank you to our peer reviewer. We introduced the peer review as part of our research program last year, and that has been hugely beneficial. So to start off with, I thought I'd sort of this links into what Dean has said around why did we do a study on stewardship report. It's not part of our regular research program at RIAA. This is sort of an outlier sort of a research project in many ways, including the methodology, which I'll get to in a moment. But Dean has already highlighted the significant momentum on stewardship in our region as well as globally. In addition to those features that he highlighted already, I just wanted to mention the launch of the New Zealand Stewardship Code in September, and also this recognition that stewardship is becoming a tool to address ESG or environmental, social, and governance issues in responsible investment, hence the growth and the focus. So the next slide, please. So about this study, I've got sort of this view on the methodology, a brief sort of overview. We basically have a study that combines three different data sources, and it's also a combination of quantitative and qualitative research. So we've got survey questions, which were linked to our annual benchmark survey. So we added on special targeted stewardship questions, which we didn't report in that report, but actually kept it so that we can report on it here. Here we had 72 asset owners and investment managers that filled out that survey, and that's what we targeted their practices. In addition to that, we had a desktop study, which included a review of stewardship codes that are relevant for our investors in the region, stewardship policies of investors, as well as literature, gray literature, and academic literature. And then the third is the interviews. We conducted 24 interviews with select investment managers, asset owners, as well as representatives of supporting organizations and civil society organizations. So those were sort of more of a targeted, semi-structured interviews with fewer questions, but a chance for the participants to elaborate on stewardship practices, barriers, and so forth. So as I go through the presentation today, and when you go and access the report on our website, you will see that we will refer to the different sources of information, and we constructed a story of stewardship, really, using the information from these different sources. So the next slide, I'll jump right into the key findings. So I start off with these two key outputs. This is the first one. It's what we term stewardship framework. And what it highlights really is an overall representation of the types of stewardship approaches that we see in our region. So the three arrows point to, well, these terminologies that we came up with. We have strategic stewardship, proactive stewardship, and reactive stewardship were the three approaches. So there are definitions there. There are also characteristics. Really what we see is, number one, we see these approaches occurring concurrently, particularly reactive stewardship occurs together with the other two approaches, as well as the difference between having a systematic approach and sort of an ad hoc approach. So the reactive stewardship is an ad hoc approach, basically when there is an event or a red flag event or an issue in the media that is raised about an investee company, and then it prompts a reaction from investors. Strategic and proactive stewardship processes are more systematic, and they're much more, so they're ingrained in the day-to-day operation of investors. In terms of, on the bottom, we see, if we can just skip back. On the bottom, I just wanted to highlight that we have stewardship activities, which, really all these activities are undertaken or can be undertaken under any approach. So hence it sort of extends, the list of activities extends to cover those three stewardship approaches. Next up then is our conceptual model of stewardship. Now, the conceptual model is something that we felt the need to construct to showcase and try to make sense of what stewardship looks like, who are the key players, what sort of information flows are going where, who's all involved, what's kind of going on. So, I mean, I know that others have tackled this task, and sort of, I guess our CEO Simon has warned me that, you're never going to get it quite right, but it is a conceptual model and something that we just wanted to have to then discuss and refine and just to think about later, but really to illustrate who's all involved in our region in stewardship. So we've got our key players, our investors, or that we refer to as investors collectively in the report, asset owners and asset managers or investment managers. Then we have our supporting organizations, service providers, civil organizations. I also wanted to include investee companies on this in this conceptual model, as well as the final outcome, the environmental and social outcomes that we're really seeking. So really what this conceptual model does, it just breaks down the complexity and just identify those actors and some of the information, and just really shows the complexity of information that's flowing between, you know, investee company through to the investors, whether there's anyone in between, whether there's proxy advisors involved, and so forth. So that sort of complexity. Next up is we have a section in the report on stewardship codes. We didn't do a comprehensive study on stewardship codes. We focused on those that were identified by the survey respondents as relevant to their work. So there are a couple of common elements here, and I just circled in there the percentages of adoption amongst the survey participants. So first of all, we see that there are a lot of different stewardship codes that are adopted or used as a guideline by investors in our region. This is just an excerpt from the table that just keeps on going and going in the report. There is a tendency to adopt voluntary codes such as the UK Stewardship Code. AXI's Asset Owners Stewardship Code is also popular, but that's restricted to asset owners only in Australia, I guess. The ICGN Global Stewardship Principles are also common, and so forth. We see a lot of investors adopt various regional stewardship codes. These are necessary because they're invest in the region, and so the codes cover practices and requirements in those regions. The other interesting thing about the codes in general is that they're voluntary. They're pretty much laid out the same way. There are principles that are someone who adopts the code can abide by all of the principles or just some of the principles and explain why they don't fulfill all of the principles. So that's generally the practice that we see. The other interesting thing is that the new iteration of these codes, some of these have been recently revised, I guess, that there is this mention of ESG, the mention of climate change as a risk is sort of prominent in these codes. So there is an expectation to consider ESG issues, and quite often climate change related risks are actually identified as one of those that needs to be addressed. So almost no matter which code you abide by, those are explicitly called for, those practices. So we see the rate of adoption is of stewardship codes is on the rise in our region. At the moment, or at the time when we did the study, the New Zealand Stewardship Code wasn't launched yet, so that's missing from our table, and that's the reason why. Next up are the stewardship policies. So here in this case, we're talking about the stewardship policies that investors publish. The contents of these policies are also fairly similar. They include the philosophy, the values, the engagement activities, ESG concerns. We see that stewardship policies are incorporated into a responsible investment in ESG policy, 46% of survey respondents, or they're published as a standalone document, 39%. So that's a pretty good, if anybody's looking around and wants to find out the stewardship approach of investors, there's a good chance they'll be able to find that on the website, either as a standalone document or as part of the ESG or responsible investment policy. Next up are the stewardship activities, and there are a range of activities that we included in stewardship. Not all of these activities are available to everyone, particularly around voting and filing shareholder resolutions. That's not available in fixed income asset class, for instance. But what we see here is the high incidence of collaboration exercising voting rights, and engaging with stakeholders across all asset classes, approach to managing conflict of interest, and advocacy on public policy issues at 71% is also quite high. Next up are the ESG topics that investors engage on with investee companies. So we specifically asked and nominated some of these categories, but also provided another option and then filled in some of those. So this now covers a huge range of different ESG topics. That's really great to see, from blue economy to, geopolitical issues and so forth. I put the arrows on just a few of those. So just to link in also and draw out the collaboration, which was the top stewardship activities of what sort of issues, what sort of collaborative initiatives there are. So we do see a lot more collaborative initiatives in the area of climate change, but we're also starting to see collaborative initiatives for biodiversity and nature conservation issues. The engagement on the topic of rights of Indigenous peoples and protection of culture is most likely linked to the Juukan Gorge incident, but also the Dabura-Ngiland Business and Investor Initiative. So there is momentum in these areas around collaboration, and we're starting to see that these are also helping investors engage on ESG topics. Next up is stewardship monitoring practices. Monitoring is always really, really important, just to keep in check whether the stewardship activities are actually delivering on expected outcomes, how they link back to codes, guidelines, and principles, or investor philosophy on stewardship. So monitoring of voting is very common, over 80%. Monitoring engagement activities for effectiveness is also practiced by 77% of investors, and so forth. I guess the one data here that is a little bit perplexing is around the process to follow up with underlying managers. That's only at 46%. But this could reflect the fact that not everyone has underlying investment managers or products, and we weren't able to capture that level of detail in our survey. Then we have stewardship reporting practices. So after you've done all the work, you've done all the monitoring, we're really heavy on disclosure. We would like to see public disclosure of stewardship. What we see is 73% of those surveyed report on both activities and outcomes of their engagements. 14% don't report on engagements, and 3% don't engage or don't think that they're doing engagement, or did not respond to the question. So in terms of when you are reporting, what do we see? We see around half of investors publish voting reports, updates, and summaries of engagements to members, to their members and clients, or to the public. So we'd like to see, again, we'll be pushing for, I guess, public reporting on that, which is accessible to all, and it's something that we at RIAA can also find then on the website. The next slide is around barriers to stewardship. So this relates to the interview questions. And again, this is a long list. The interviews aren't really well suited for the percentages, because we had fewer interviewees. But nonetheless, what we see is a range of different barriers. On the left-hand side, structural barriers and limited resources really came out as key issues. The limited resources were around time, were around capacity, like staffing, around knowledge required to really do stewardship well. On the right-hand side of the slide, you see some of the quotes from our interviews that illustrate, and I thought really well, what the issues were. You need to know a lot about companies. ESG people are marginalized and siloed within institutions. No single investor is the only change agent, so the need to collaborate, and so forth. So I thought those quotes were really fitting. And researching and finding out barriers is always a really important part of recognizing barriers and then moving forward. And then the last slide is around the future of stewardship. So we asked interview participants to tell us where they think we should be going, or where stewardship is expected to go in the region. A lot of them highlighted the need for training and communication. In terms of communication, the emphasis here is on the role of stewardship in responsible investment. So we need to educate the public and communicate what stewardship can achieve. The focus on climate change in stewardship, and the need to adopt new ways of thinking, particularly systematic thinking or systems thinking. And then again, I had the quotes on the right that really capture it all. And I just like to encourage you to access the full report on RIAA's website. Our research is always available to the public for free for anyone. And I'll just leave it at that. Thank you.
Okay, thanks, Zsuzsa, for a run through of the findings of the research. So we'll now move on to the panel part of our session today. So I'm going to introduce a couple of our additional members today. Firstly, Mark Spicer. So Mark is one of my fellow partners and of the climate change and sustainability team within KPMG Australia. He's been with the team since 2006 and heads up our responsible investment services. And I know for sure he is passionate about the intersection of capital markets and ESG, a passion that I share with him. We also have Sushila Perez da Costa. So Sushila is the principal at the Stewardship Centre and chair of the Responsible Investment Association of Australasia. She's a director of the Nature Conservation Council of New South Wales, Beyond Net Zero Emissions, and the US-based think tank, the Shareholder Commons. Sushila has advised many financial institutions on responsible investment, governance, strategy, and implementation since 2006. And her clients include some of the world's leading banks, pension funds, wealth advisors, and asset managers, alongside major global responsible investment organisations such as the UN-backed Principles for Responsible Investment. And she is also the author of its key pieces of Advanced Stewardship, Active Ownership 2.0, and Making Voting Count. Also joining us on the panel today will be Dean Hegarty, who joined us with some opening comments. So first of all, I'm just going to ask each of Mark and Sushila and Dean if you're able to share some initial takeaways that you took from the report. So first to you, Mark.
Thanks, Scott, and thank you, Zsuzsa, for the compliments for the young KPMG team. I'll accept those on their behalf. Scott, there are a couple of elements that stood out for me. The first is the enormous increase in prevalence of stewardship as a responsible investment strategy. Dean pointed to it, 54% is enormous. And I think this indicates a growing maturity in the responsible investment industry. A negative screen is relatively easy to apply. A stewardship approach is more nuanced, it's more complicated, it needs more resource and more thinking. If I were to be a little cynical, I could suggest that a poor stewardship approach was a means to claiming responsible investment whilst maintaining the status quo. However, I think some of the results we've seen in this report and the increased focus on greenwashing probably removes that risk. Now, as you know, I work with both corporates and investors on their ESG strategies, and I'm seeing this growth in stewardship being reflected with my corporate clients. The coverage of questions is certainly increasing. There are very few companies now where I talk to a CEO and they're not getting questions from their investors around ESG. So that's a massive change over the last 18 to 24 months. And also the quality of the engagement is improving. Historically, we've heard questions are checklist orientated. We're not sure that they're being focused, but certainly the leaders in stewardship are asking far more nuanced and powerful questions to these CEOs and really getting the attentions of the board. And I think this links to the comments of stewardship that Zsuzsa pointed out to, that to do stewardship well, you really need to have a strong understanding of a company that you're talking to. And I think also, to be fair, that works the other way. The company themselves need to have a strong understanding of their own ESG strategy and the data that they're putting out. So I think there's, the conversation is starting between corporates and investors, and we're seeing a maturing of that. There are still some steps to go, but I think there's some excellent move forward, excellent steps to move forward. Sorry, and one of the key contributors to that stepping forward in that maturity is this collaboration. So we're seeing great collaboration between investors now, driving the ESG outcomes, leveraging the skills that do exist across the industry, driving consistency and increasing the quality of the questions that our clients are receiving. The final thing I just wanted to add was really sort of a call to arms. I know a number of you on this call are already participating in stewardship, but what I wanted to mention was every ESG question that's asked to a CEO or through the investor relations team increases the level of visibility and focus within that investee company. So please do not underestimate the power that the good stewardship can have and the effect that it can have on those companies that you're investing in. Okay, thanks. Back to you, Scott, or on to Sushila.
No problems. Thanks very much, Mark. So across to you, Sushila, for your thoughts.
Thank you. And thanks for having me. I've been fortunate to be part of the stewardship community in Australia since the mid-2000s. And I think Australia itself has been very fortunate in coming very early to the idea of effectively partnering with organisations to understand what the barriers to improved performance were. One of the things, though, that I think has happened is that as stewardship began to be codified, as engagement came to be an expectation under PRI, as stewardship codes started to emerge, there came to be much more of a focus on activity than on outcome. And I think that's because we expanded the community to those who would like to be able to demonstrate that they really are living up to those codes and complying with the commitments that they've put forward. And that's an admirable thing. But in the process, we oriented ourselves a little too much to process and not sufficiently to outcome. So I was really interested to see in the report evidence of recognition that not all engagement is stewardship. Lots of engagement where you're just making inquiries of company is the traditional bread and butter of asset management processes aimed at better understanding the company's value. They have nothing necessarily to do with ESG and certainly not to do with outcomes. And not all stewardship involves engagement. I think that's a really important point too, and it was wonderful to see that brought out in the framework that Zsuzsa presented. The other couple of elements that I really liked about the two, so these are the two diagrams that I'm talking about those two diagrams, are the clear distinction between strategic stewardship, proactive stewardship, and reactive stewardship. I think if we were to dig deeper into the issues that we were talking about, the many issues that ESG issues that were identified by investors as things that they'd been active on, we might find that there's rather less proactive stewardship strategic stewardship than proactive and reactive stewardship. And that's not ideal. So the best use of stewardship right now is to create the circumstances that allow all of the things we know need doing to happen. For corporates to flourish, for the environment to be protected, for human rights to be advanced, all of those things that I imagine pretty much everyone on the call today is going to be working towards in some form or another. Those are big systemic issues and they do not lend themselves to optimizing at the level of individual companies. So if you're coming to a company as an investor, even with an ESG issue, and your main way of thinking about it is the risk to the company, you're going to be missing a very large part of what needs fixing today. That was one of the reasons that the PRI was interested in engaging on the Active Ownership 2.0 work, and that was a key feature of the Active Ownership 2.0 work, which for those who might not be familiar with it, really came up with 3 core concepts that are key to advanced stewardship. One of those was that it needs to be focused on outcomes, not just processes. And those outcomes, it doesn't mean you can't focus on something like disclosure, but you have to be focusing on disclosure in the context of knowing what that disclosure is going to be used for, and that use is going to make a difference ultimately to the outcome. The second concept was common goals, because everyone naturally has an incentive to optimize at the level of the individual company. Even asset managers who aren't bought into any of the responsible investment program have a responsibility to do so, have an interest in doing so. So that's not what we need to replicate. In those cases, it might be a case of just more information needs to be provided about what does create that performance improvement. The issues that we really need to grapple with as a community are the ones where it's not optimizing for the individual company. In fact, it might at sometimes require some compromises in terms of maximizing financial value at that company, even considering it long term. So that's common issues. And to achieve those two things, we need to be absolutely guns at collaboration. And so it was awesome to see also that some of the top 3 barriers and obstacles that had been identified by the interviewees were barriers to doing more of it, were all things around lack of resource, all things that could be solved by better collaboration, lack of resources, lack of information, the depth of information that you've talked about that's needed for each company, and lack of infrastructure. So I think they were the top 3. I might be paraphrasing, I haven't got them in front of me. The great news is that, in my opinion, speaking as a completely unbiased chair of the Responsible Investment Association of Australasia, we have one of the most amazing pieces of collaboration infrastructure of any market or region anywhere. We have a community that largely knows the other participants. Many of us work together daily, sometimes play together, have worked together over many years to develop the kind of trusted networks with each other that enable us to have honest conversations about what's missing, what needs to be done, who can do it, where the resources are to fund it, who's best placed to coordinate it, and so on. And RIAA has a few of those working groups now, and you can see from the evidence that they are incredibly effective at achieving those outcomes. And so I guess, what I mainly take away from this report is the huge opportunity there is to get even more engaged under an umbrella like RIAA that allows us to bring together lots of different parts of the investment and corporate supply chain to be able to collaborate more effectively for the outcomes, for the overall stewardship program of activities that different actors need to perform for us all to get the outcomes we need.
Okay, thanks, Sushila. I think there's a fabulous message of collaboration which we all, I'm sure, would endorse as we work across the industry and into the real economy. So I'm also just going to ask both Dean and Zsuzsa also to make a few comments about their takeaways from the report. Perhaps just in a little bit of a shorter time frame than both Mark and Sushila, and then we'll get on to some more questions. So perhaps over to you, Dean.
Really, I think the issues that Sushila and Mark have talked about are perfect, and really get to the crux of it. It's just the scale at which this is happening is probably the biggest marker for me, and I think the thing that we need to pay the most attention to. 82% of investors talking about the collaboration that they're doing within the industry, that has really grown at a rapid rate. And while I think we do get to see a lot of the early trends at RIAA and the access we have both to members but also to those working groups does give us that insight. I had underestimated just how much of that collaboration was going on, which is incredibly exciting.
Okay, thanks, Dean. And Zsuzsa, just some insights from you that you wanted to add in addition to the research.
Yes, of course. I mean, the research will have implication to RIAA's work, particularly around defining leadership. This is something that we're going to be looking at, and this is something that we do each year through our benchmark report. So we are planning on utilizing the findings around best practice and activities and what's going on to refine the pillar on stewardship for our leaders. I'll leave it at that for now.
No problems. Thanks, Juja. So Sheila, the first question to you. This report, for the first time, gives us a good idea of where stewardship practice is in, from an Australian and a New Zealand perspective. How does this align with what we're seeing, from a global perspective?
I can't speak to the statistics from a global perspective, but I can speak to what some of the leadership, the leading stewardship activities are doing. And they are much more focused on where do the obstacles lie to the progress that we need, rather than the more exploratory side of stewardship that's often a more familiar and a more comfortable entry point for those that are newer to it. So I'm not sure that we've seen anywhere quite what we saw with some of the recent stewardship activity in Australia, and being able to connect the dots, for example, from a series of engagements and expectations set through engagement right through to a more assertive communication about what you would want from a board, right through to director elections. That's really a full chain that we haven't seen very extensively anywhere else. I would expect a lot more of that to be coming from leaders as they look to that model. But again, it's about this honest grappling with the idea that not everything can be optimised at the level of the individual company. Not everything is consistent with individual corporate values. Some activities are not consistent with, the transition that we need on climate, just to give one example.
And would you give any advice to all the investors who are online here in terms of how to tackle that? It's obviously you mentioned that the challenges around collaboration, but there's obviously very clear value trade-offs that are faced with, and that ultimately probably leads to different winners and losers, potentially within organisations. So any advice in terms of how to grapple with that dilemma?
Yeah, look, it's probably no different to any other business dynamic. There are always winners and losers. When Kodak made a choice not to go digital, there were consequences from that choice. And those kinds of transitions occur all the time. They've happened throughout our industrial history, and certainly through, the last 50 years where technology has played such a big disruptive role. So we should not be shy from recognising that there are other drivers of those kinds of disruptive changes. And I think one of the big obstacles is our reticence to admit to that as a responsible investment community. There would be no hesitation from, the likes of an Amazon about the demise of certain retail chains as a result. That's just business in their eyes. There's no reason that we should be thinking about that necessarily any differently. The other thing just to be aware of is that a lack of stewardship, pushing for the outcomes that you need from a total portfolio perspective. And so, the universal owner perspective really shapes the stewardship agenda in the sense that they cannot exit their exposure to anything really. They own a slice of the whole economy and its performance in perpetuity. So the other part to that is just recognising where the dysfunctions might lie in terms of which agents don't have a natural incentive to be supporting the agenda, and therefore what needs to be done through other channels.
Yeah. Okay. Thanks, Sheila. Next question I'll go across to Mark on, but just as a reminder, I've got a long list of questions here, but we'd certainly welcome some from the audience. So feel free to pop those in the chat or get them ready to jump in when we move into that stage. So Mark, across to you. How do you think ESG factors are going to play into stewardship practice over time?
Thanks for that, Scott. I think what we're seeing from an ESG point of view across Australia, or what is increasing ESG reporting from our corporates. We have a government now that hopefully will be more encouraging of consistent reporting of performance across the corporates. And we're seeing that, with the formation of the ISSB, integrated reporting coming to the fore, a deeper understanding at that corporate level of what ESG means to the corporates from a value point of view, and a consistent, or if I look to the future, 2, 3, 4 years, a consistent performance reporting across corporates. Hopefully the impact that I see from this is then stewardship can focus on the higher value strategic sort of focus areas, rather than data identification or those sort of basics. What are you doing around ESG? Because the consistent reporting will have forced that through, and the materiality and the maturity from the corporate side will have improved. So hopefully consistent reporting from corporates over the next few years will assist investors generally and drive the value of stewardship going forward.
Great, thanks, Mark. Over to you now, Dean. So what are you hearing from RIAA members about stewardship? And how does stewardship materialise for RIAA members?
Yeah, so I think what we've seen, without question, is that the focus has grown exponentially in recent years. That's the feedback we get from all of our members, and in particular, when we look at the working groups that we run, which Sushila has already mentioned, we're just seeing that is stewardship and stewardship activities are becoming a much bigger focus of those groups, and where more and more of the time is going on them. So for those who aren't involved, we have working groups that are focused around the themes of nature, First Nations people's rights, as well as human rights. And a lot of the feedback that flows out of those is that a lot of the challenges that we're facing and that we need to be solving really do require system change, and that is something that engagement is required to be able to deliver. And so obviously that collaboration piece and the need for that is really significant. I think the other reality that we're finding is that there's a real demand from members on being supplied with practical guidance on actually how to start doing some of these things. And so the report today is a part of a response to that. The working groups that we operate are regularly putting out some incredible toolkits. We've got ones on modern slavery, cultural heritage protection, actual resources that people can take into their organisations and use to implement change. I think we need to be continuing to drive that, because it's an essential tool if we're going to actually achieve outcomes, which is what this is all about.
Okay, great. Thanks, Dean. All right, so perhaps across to you, Zsuzsa. What are the first steps for an investor wanting to begin stewardship? Imagine blank sheet of paper. What would be the first, which I imagine is not the case for anyone on the call here, but, hypothetically, what would be the critical things that you would focus on to get started?
That's a good question. Yeah, I mean, so everyone would be doing stewardship in some shape or form, I would say. Not necessarily from an ESG perspective, but as a, just being prudent and following practice as investors. I think I thought that the codes give a really good starting point. And I would, in comparing the codes that are relevant for the region, and particularly like the Active Ownership 2.0, that standard, those principles really set a new perspective, I think, for investors around that can help us through the next challenges of climate change. These really complex problems where we rely on collaboration and so forth. So if someone is looking for a refresh on their stewardship, I'd say take that as the basis, and see how you can meet those guidelines, what it takes, decipher some of those meanings. Then, the codes themselves pretty much, so they provide a guideline from start to finish on what you need to do. Stewardship policies, definitely, or incorporation of policies on stewardship is really important, and a good measure of accountability. So those policies will set you up, what is it that you'd like to achieve, how you set out to achieve them, and so forth. So I think the policies are actually common practice, so something that needs to be done. I also think, one gap, I guess, for us is around fixed income. And how do you do stewardship around fixed income? So I know we have some RIAA members who are interested in that. Fixed income is really growing as an asset class for responsible investment. So I think that's a bit more difficult. There needs to be maybe some more collaboration on fixed income and how to do that well. And of course, amongst these activities, I think the strategic nature of setting it up. I mean, what is clear from the barriers and the interviews there is there are a lot of issues. We don't have enough ESG practitioners. We don't have enough time. So being strategic about the impacts and outcomes an organization wants to achieve can really help with that. You don't have to save the world with, every single environmental problem, because no one can. But pick the ones that are most relevant to the organization, the most relevant to your geographical region, for instance. Be strategic and be systematic in following up, ticking them off as you go along and progressing, making progress.
Can I add to that one?
Of course.
In a lot of cases, stewardship doesn't need more voices doing more things. What it needs is more support for the existing voices already doing those things, but at risk of not doing enough of them or not having their resourcing continued or whatever it is. For almost every issue that we could think about, there are already organisations, and many of them our fellow investors, working on some part of that. And so being able to navigate to those and throw your weight behind those is actually a much higher return on your investment of time or effort or even money than it is to establish your own first steps in stewardship. And because it is a collaborative endeavour, because everybody benefits, there are very few competitive dynamics in the stewardship space, unlike, for instance, in the other parts of the responsible investment space where products might compete with each other. So people are very willing to share their insights if you're willing to share your influence.
Okay, so I might just move to a question to whoever wants to jump in and address this one. I think just some of the comments here are around, obviously engagement and collaboration. There are a number of codes. I think it was obviously put up in the research that there's various codes that exist, and that obviously presents a range of challenges in terms of, well, how do you implement? What do you think is the role of regulators, to provide clarity in terms of frameworks, standards, codes going forward? Obviously, there's links into broader aspects that government is looking at in terms of taxonomies and other aspects. But what is the role of government and regulators in providing greater clarity in terms of expectation of the capital markets? Yeah.
Have a go?
Yeah.
Somebody else jump in if you want to go, because I could go on for ages. Look, I think it's important to remember that the UK Stewardship Code, which was effectively the inspiration for all the others, it came out of the K Review, which came out of the financial crisis. And the focus there was about protecting investors in companies from agency risk that might occur as a result of intermediaries who invest for them. So fund managers not necessarily paying attention to what those companies that they bought on behalf of the investors are doing. And that is important. That's in a good investor protection type code. But I understand that while some of the codes have progressed beyond that, they're not primarily about many of the things that we as a responsible investment community are thinking about. Those are absolutely important, and they're important levers for the outcomes we're talking about, but they're not the whole story. And so I'm not sure we can rely on regulators to lead us where we need to go. And that's why I have so much, so much faith in the role of organisations like RIAA for Australia and New Zealand, the PRI in terms of their support of ideas like active ownership 2.0. Some of those investor networks are some of the most powerful levers that we have, not regulation.
Yeah, I think very well said, Sheila. I think if we got to take control of the destiny of the sector and make those changes, and I think RIAA is obviously doing a fabulous job with that. So look, we've just got a question that's come in. So this is from Ali El Salah. If I get that probably not even close to right, but my apologies, Ali. So do you think stewardship is allowing the opportunity for companies to deliver poor ESG using the privileges of happy to engage with investors, which may take a long time for good outcomes, whereas negative screening can, in a way, penalise companies for poor ESG? So I'm sorry if it's a bit of a I didn't quite get that out, but perhaps did everyone understand what that question was going to? Basically, negative screening versus delivering positive outcomes, and whether that's actually happening at the moment.
I'm forcing myself to keep my hands down.
Yeah.
Well, let me have a quick go at that, Sushila, and
Yeah.
you can add to it. I think negative screening is prima facie simple to understand. It's simple to describe to your investors. However, once you've screened that company out, you have no further influence. Stewardship, it's in your hands. You can still have an influence. And as Sushila pointed out, the universal owner, if you can't divest everything, you can't divest your way away from all of these risks. So and also to my comments, stewardship does make changes to businesses. I think in the short term you can be met with a straight bat or poor responses, but over time that stewardship and engagement can make a difference and will make a difference. So I'm very much in the camp of good stewardship rather than a negative screen. Sushila, want to add to that? I know you do.
Ali, I might be cheeky and say that in your question, the words allowing and penalise are doing a lot of work. So there is a question in the case of large established listed companies. I'll assume you might be talking about something like tobacco companies or fossil fuel companies that generate revenue, recurring revenues very healthily. That doesn't penalise that company when you sell the stock to someone else. In fact, that company's stock is sold every single day between investors. Even if it happens so much as to push down the price, it wouldn't penalise the stock. Right, it might penalise any manager whose KPIs are around the share price, but that's something we could take a whole nother session on. But on the whole, it doesn't make that difference. In fact, what it does is mean, if we were to take it to its logical conclusion, a world in which someone like Saudi Aramco ends up owning all the fossil fuels in the world, because the problem's not supply of capital. There are instances where supply of capital is a problem, and that's typically on the other side of the economic equation, where great ideas don't get funded to be commercialised. So on the renewables side, for example, we still need more capital being deployed to compete with the old industries, but it's not a capital supply problem. In fact, in the last quarter, I think it was, I can't remember which of the oil companies it was, but it made record profits, bigger than it's ever made before, because there was a supply constraint on the oil, because of Russia and everything else. It pushes up the price. They make more profits if there's more constraint on supply. So it's a convoluted way of saying it, but I'm very happy to have a longer conversation about it. It does, though, lead me to the question that I desperately want to ask the others on the panel, which is, how far away are we from a situation where enough of the community understands stewardship and its potential, such that we, people investing in doing it, investors, institutions investing in doing it, aren't faced with this criticism around, or you're not divesting and engaging?
Well, Sushila, unfortunately, we're going to have to pick up that debate another time. I'm sure we could continue talking about that. I mean, but it's definitely one that's certainly alive and well. So, look, thank you to each of you for contributing to today. I'm just going to hand back across to Dean, who's going to wrap us up for the day. But thanks everyone for joining. Dean, back to you.
Thank you, Scott, and thank you for the insights from Sushila, Mark and Zsuzsa, and for the questions that came in. Look, final thoughts from us. I think it's really important, as well as taking insights away from things like this, and being able to go back and look at what we've learned. I think it's really key to take away what are the next steps. So where to from here? Now that you've listened to this and having read the report, what can you do next to actually start to make change in this area? I think from RIAA's perspective, we have working groups that are operating that you've heard a lot about. I would highly encourage you to get involved in those if you are not already. Whether you're an expertise who has, whether you're an expert who has something to contribute, or you're somebody who wants to learn more about what's going on in the industry and collaborate, that is a huge opportunity existing within those working groups to tap into the expertise right across the industry. So I'd highly encourage you to get involved. Particularly for those in here in Aotearoa, there is a stewardship code which has just been launched. Very proud to say that the 7 founding signatories are all RIAA members. Were all recently named as leaders on RIAA's RI list from the benchmark report. There are a lot more companies to come on board for that. So on the 9th of December, there is an event that will be held where you can learn and understand more about signing onto that code, what it means. Those of you who are RIAA members would have received some details about that yesterday in your inbox. Jump online to the Stewardship Code New Zealand website to find out more details if you want to. And finally, we do have annual conferences that run in Australia and New Zealand. We are right now putting together the program for our Australian conference, which will be happening on the 10th and 11th of May in Melbourne. Stewardship, not surprisingly, will be a huge theme of the concept that runs throughout. So I'd highly encourage you to get along to that conference. If you haven't come before, it is a fantastic event. It is the largest event of its type in Australia and New Zealand. For those in New Zealand or who can't make it, you'll be able to view virtually as well. So lots of options there. Final piece from me is just a massive thank you. A thank you to KPMG, who have done an incredible amount of work on the report. A thank you to the panelists who have contributed so much expertise and insight today, but in particular, a massive thank you to our members who, as well as funding this kind of research and allowing us to do this kind of work, also are the contributors of the insights and the data that allows us to learn things from them. So we took data from 70 members across the industry. We did deep dive analysis, case study interviews with 24 members, all of whom gave time and expertise to help us pull this insight together. And so a huge thank you to those for continuing to allow us to do this kind of work. Ngā mihi nui, have a great afternoon.